Right. Intro to depository institutions is the topic today. Now, depository institutions, it just is another term for a bank or another financial business. So I'm going to substitute the word banks in a lot of times for that very long and complex word. So, what is a bank? A bank is a business that provides financial services, and that's going to go at the top of your note taking guide, the first definition. So, two types of depository institutions, and this is why you can't normally just call it a bank, is because there are banks on the side, but there are also credit unions, which are technically not banks. So, they are both places where you can deposit money and perform other types of financial services. So, here's the difference between a bank and a credit union. A bank is a for profit business. Their business is to take your money, hold it, and also use it to loan out to others. And through interest, they are then earning money and making a profit. And the profits are generally passed on to the shareholders within that company. Credit union shareholders are technically everybody who has an account at that location. So, you, by putting your money into an account at a credit union, you are now a shareholder. Everybody's equal. If there are profits made, which there are because they also earn interest on their loans, then they typically will put that money back into the credit union, maybe to provide more services to their um, members, they call them, or possibly even they will pass that back on to you in the form of actual cash or lower interest rates. A bank is open to anybody at all who wants to put their money there. However, credit union, you typically have to meet some membership qualifications, and that could be that you are a part of a certain industry. Maybe a welders union has a credit union. Maybe a certain branch of the government will have their own credit union. Maybe if you work for a certain company, there will be a credit union provided for people who work for that company. At any rate, there are some type of membership qualifications. So you, as just a general person, cannot go to any credit union and open an account just because you want to. They both offer many of the same financial services. In general, you might say that banks have a broader variety of financial services than a credit union. And again, a very general characteristic of bank may be that it is typically larger of the two. And also very common is that credit unions pay higher interest rates and charge lower fees. Each one is unique, one not better than the other. You just have to look at what is right for you and make the best decision. Another reason that you might choose a specific bank, is location. So, does it have a physical location? Is it only an online bank? Do they have more than one locations around the US, or just in your state, or just in your town? And do you have the transportation to get to the location? So, those all might factor in when you're looking for where to put your money. Depository institutions, banks in general, keep your money safe. It is much safer to put it into the bank than to just keep it in your home somewhere. And that's for several reasons. One, they have security measures, they have safes, they have secure networks, and they also have insurance. So if you keep your money in your house and your house burns down, that money is just gone with it. But if you keep your money in a bank and something happens to it, even if they have, a robbery or something like that, that money is insured up to, and here's the part that goes on your note taking guide. What does it cover? Up to $250,000 per depositor, that's you, per institution, that's your bank, per account type. So you can have a checking account, savings account, money market account, a CD, $250,000 in each of those, and your spouse has them as well, and all of that money is insured. We don't usually have to worry about that in this location, do we? So, businesses offer services to the public, and a bank is also a business. So, grocery stores offer groceries, restaurants offer food. A bank is going to offer the following services: transaction and savings tools. And that just means checking and savings accounts, places to put your money and use your money, credit in the form of either credit cards or loans, financial advice, safe deposit boxes, a place where you can securely store any personal items that you want. They're inside the vault, inside the bank, and special needs payment instruments, which we'll talk about in just a second. So the next part of your note-taking guide is talking about interest. What is interest? Interest is defined as the price paid for using someone else's money. So when the bank lends you money, they are providing you a convenience. You now have money that you didn't have in order to buy the thing that you need. But for that convenience, you're going to pay back the bank interest. And that's how they make their money. But on the other hand, when you put your money into a bank, you are depositing it there. They're going to use it to loan out to other people while you're not using it. And for that convenience, they're going to pay you interest. So if you have a savings account, you're expecting to put money there and leave it there, they're going to reward you with an interest rate. The interest rate is just a percentage of the total amount that you have in the account or the amount that you have borrowed. Two types of savings tools that are very common are checking accounts and savings accounts. Yes, checking accounts are technically a savings tool because you're putting your money there and not expecting to spend it all right away. These are both accounts that are going to help you manage your money. They may or may not earn interest. So, looking at the difference between checking and savings accounts, a checking account provides quick access to your funds. You can access this money by writing a check using your debit card, withdrawing it from the ATM and cash, electronically transferring money, among other things. Some do earn interest. You can find a checking account that earns interest, but it's very typical that a checking account does not earn interest. And that's mostly because your account balance is constantly fluctuating. You're not leaving money in there for any length of time for the bank to be able to loan it out to someone else. A savings account, however, is an account that's used to store money for a longer period of time. It's not intended to be used for your normal daily expenses. And therefore, the access to that money is usually limited, much more so than a checking account. And because of that fact, they are going to earn interest typically. Going on to page 2, credit is defined as borrowing money. So when you hear credit, you probably think of credit cards, and credit cards are borrowing money as something that you have to pay back. But it can also be a loan. That is another type of credit. So again, you're borrowing money, you have to pay it back, and you usually have to pay it back with interest. Other services that depository institutions may offer: financial advice. You can talk to anybody who works at a bank and they will probably be able to answer some of your financial questions. A lot of banks will have more qualified individuals who may be able to help you with other specific problems: how to get a loan, how to build your credit, how to get started with investments, and things like that. They also offer those safe deposit boxes, a place where you can store your valuable personal items, and special needs payment instruments, which are listed here. Things like traveler's checks, certified checks, cashier's checks, and money orders. These are things, so for example, you need to pay somebody who you've never met and you need to pay them $1,000. If you write a check, first of all, it's illegal to send cash in the mail. So you don't want to send cash in the mail. It could, something could happen to it, somebody could steal it. If you send a check, the person has never met you. They don't know that you have the money in your account, and they don't want to take that risk. So if you get one of these things, a certified check, a cashier's check, a money order, those are going to be the same thing as cash, but in a more secure format, so that the person just has to take that cashier's check, go to their bank and cash it, and then they have their cash and they it's already cleared the bank. So they know that you're good for it. Features of depository institutions. Um, the first one we're talking about is online banking. So online banking is using your bank on a website. Usually you have a username and password. It's a secured internet site. Banks pay a lot of money for cybersecurity professionals to make sure that all of your information is safe online. Yes, breaches can happen, but it's definitely, I mean, it's just that those are the people who pay for the most advanced software in and professionals in that area. On this website, you can usually access your account information, transfer money, set up bill paying, apply for loans even, and among a lot of other things. Mobile banking, exactly like online banking, except that it's formatted for a mobile device. Usually not quite as many services on the mobile devices, on the mobile app, but they are constantly coming up with more things that you can do, like even making deposits by taking a picture of the check and things like that. Debit cards are a plastic card that are connected to your depository institution account. It functions like a check. So when you write a check, you write it to the person for this amount, they go cash it, except now we're doing that whole process in a much faster way and more portable way too. It usually uses a PIN or a signature to authorize transactions. An ATM is a machine that allows you to use certain transactions without a human. So it's called an automated teller. A teller is the person who works in the bank who usually helps you at the window or the counter. And so an ATM is the robot version of that person. More and more things that you can do with ATMs, but basic stuff is to withdraw money, deposit, transfer, or just check your account balance. Um, and you usually access that via your debit card and your PIN number. Contactless payment is any kind of payment like at the checkout that you are using without actually swiping your card. So if you're waving your card, if you're using your phone to show a QR code, if you're using your watch, if you're doing Apple Pay, any of those kind of things where you are not physically coming into contact with anything else, contactless payment. And those are becoming more and more widely used. And the last thing we would need to talk about are fees. Fees are something that are inevitable, but you want to know what types of fees may be charged, especially if you are looking at different types of accounts or different banks that you're comparing two different options. So, looking at what the fees are and making a good decision for what is right for you. Common fees are going to be an overdraft fee. That happens if you try to spend money that you don't have in your account. Commonly, overdraft fees are about $30 per transaction, and those can just really snowball. If you get one, uh, then you try to spend more money or something else clears the bank and you get another charge and another charge. Just talk to your bank if this is the first time it's happened, especially let them know what the problem was. More than likely, they're going to work with you to maybe erase those fees, but you've got to open up some communication there. ATM fees are also common. If you try to use an ATM that's not owned by your bank, typically a charge will incur. And then also sometimes there will be a minimum balance fee. So if your account requires that you keep $50 in there at all times, then if you drop below $50, you get a fee charged. So you want to be aware of that for sure. And so just to wrap up, as you're looking for a bank, you want to make sure, again, to research the fees, know what they are, know how to avoid them. And then any of these things right here may be factors that you would analyze to choose one bank over another or one type of account over another.